Alright, we have a doggy coin coming out on Xen that will eventually make Xen more deflationary as long as people participate into this project. Overall, it's gonna make Xen go up even more, and it's very important that you actually get in on day one because there is an amplifier bonus that is given out for day one minters of Doge, Xen Doge. So you can see the current bonus will be 1500% at launch. If you do want to participate in Xendoge, that you do it from day one because of that bonus amplifier. And then over time, as more Xen gets burned, then what eventually happens is that bonus amplifier goes down. Now we're going to be talking about a lot of things here. We're going to be talking about how this is very good overall for Xen. We're going to discuss a little bit of Pulsechain burning that's happening and go over the Bitcoin consolidation phase that we're currently in. You can see this generated from Jack leaving his own dog that he has, his own puppy. This is supposed to have all the donations going to charitable foundations, but however rewarding the Xen community, rewarding deflationary and not rewarding bad behavior as we've seen in the current economic landscape. We continue to face inflation around the world with the United States dollar. However, we do see many crypto assets just like Pulsechain and Plsx come out and start burning and making their own supply deflationary. Why do you want to participate in the community when that crypto asset is basically inflated to oblivion? Now, what we've seen so far with Pulsechain is that 1.1 billion have already been burned. So that's good overall because this shows that there's a lot of people participating in this chain. And even the Ethereum gas fees have gone down substantially. Now, is it due to Pulsechain? It's too early to say. But from what we've seen is that people want to interact with Pulsechain. People want to interact with Plsx. And that Xen is going to be a huge critical asset on Pulsechain. So we've already seen 32 billion burned of Plsx. So meaning people are participating, they are farming, they are providing liquidity pools, which is good overall for the environment, the whole ecosystem. We always talk about the narrative, guys. We say that the narrative has been driven overall in the next year or two, that these coins have to come out and start making their ecosystem more deflationary. So rewarding participation, because if you're not participating in the ecosystem, it's just a dead ecosystem. That's what Xen is doing. It's bringing in user adoption by having you participate constantly, burning Xen, so that you get rewarded overall for holding not only the coin that you're burning for, but also Xen itself. And it ties in with this whole thesis that if you are burning Xen, then you're going to be eligible to get that airdrop for X1. The X1 airdrop is the whole key to this, which will connect back into Bitcoin, and why we've been discussing overall the ordinals and what's happening with smart contract capabilities coming to the Bitcoin world. Without participation, you will most likely be left behind, because if you stop participating and somebody comes in and starts minting, they start minting faster than you, then you're going to basically fall behind the ladder. Now, I'm not saying go all in regards to one particular asset, but what we've seen is that, look, this ecosystem rewards people who continue to participate into it. And that's why we're not going to continuously see these dead chains just sitting there not doing anything. And I think that's very key overall. If you try to do a vanilla mint and you click on Pulsechain on Xen.network, we can see it's currently costing, based off of the gas fees, on Pulsechain, it's costing you about 14 to 1500 PLS to start minting some vanilla mints on Xen. So if we go to trade here and we just see exactly how much that's costing in current price based off of whatever the beats are, it's currently costing you 28 cents to mint one account. Now, if you wanted to actually mint a XenFT, guys, we can go to the XenFT tab. You can click on mint XenFT. And if you wanted to mint a Xenterion here, let's see the actual cost. It was roughly around 150. Let's do max term. Yeah, this is max term, 424 days. And currently, it's 178,000 to mint a Xenterion, which equates to, if we go back to Plsx here, that equates to about $35 to mint max term as Ethereum at the current prices. Now, the more people that continue to come to Pulsechain, continue to interact with it, the more expensive the gas fees will be, meaning it's more expensive to actually generate as Ethereum. Now, we're seeing on Ethereum, if you go on the Ethereum chain to mint as Ethereum, it's costing about more than about 1,500. Let's go ahead and check it out real quick, just to show you the comparison here, the difference between them. The more liquidity that comes into and drives these gas fees, the more harder it is to mint on that network. But that's the whole value proposition, is that because the network is so valuable, the more valued these as NFTs are going to be. So if we wanted to mint Ethereum on max term days, how much is this going to be? It's costing about 2,598 on max term Ethereum on Ethereum. Again, these gas fees continue to drive up. Then overall for the Xen ecosystem, it's going to be more valuable by minting, being an early minter. That's why I was showing you this, is that you want to be an early minter. Currently, Texas Senate passes a bill requiring crypto exchanges to provide proof of reserves. We've seen this throughout the year. The regulation is going to be hampering down a lot stronger because they want to have their tax bills paid off. They don't want you to invest in this crypto space, make 100x, and you're not actually paying any taxes. So they want to ensure that they know your activity. They know what's going on. They are going to implement these KYCs across the board, and they're going to also implement the ability that requires these exchanges to provide proof of reserve. Because if they don't provide proof of reserve, we don't know in the back end whether or not these exchanges are actually compliant overall with what they've been saying. What do their balance sheet look like? This is actually saving the little guy to say to yourself, okay, should I have my funds on a particular exchange? At no given time should you have your funds in an exchange, because that was the whole point of the crypto space, is that you self-custody your own funds. Showing incompetent exchange behavior, the user can understand whether or not you're liquid with these particular assets. If you're not liquid, then that spells very bad overall for that crypto exchange, and maybe you might want to get the hell out of that exchange because it could end up going bust. So this is good. These things that are coming into place, things like this is good because it's protecting the average investor by providing proof of reserve from the exchange. And proof of reserve should be provided by anybody when you're running a bank in particular. We should be able to see your bank assets. We should see your liabilities and your assets sections. If we're not able to see that, then this is not good overall. We don't know the type of behavior that's going in the back end. We don't know the activity that's occurring there. So this regulation is good regulation, but hampering innovation is not good regulation. Whatever United States has been doing there, I know that some states are working towards something a lot more better, that's more friendly in regards to regulatory, and this bill is one of those. I commend that. Now we're seeing Ledger come out saying that if the United States government were to ask for us to retrieve the private keys of a particular ledger, that they can actually do that. So how safe are these ledgers? We talk about self-custody, and this goes back to this, the regulations and things like that. We talk about self-custody. Now, if you're self-custodying using a ledger, and that you know that at the end of the day, ledger can actually get your private keys, how are you actually self-custodying? You're not really self-custodying if somebody can access your funds knowing that they have a back-end loop to go in and do these things. Now, this is just like Facebook. This is just like Google, more centralized in some way, where they provide information back to the government, and same thing that goes with Ledger as well too. Now, I don't want to continue rewarding bad behavior because this is bad behavior, guys. I would recommend that if you wanted to switch to a Trezor that actually doesn't have a back-end loop. So this goes against everything that crypto stands for, and this is very bad for the crypto space. If a lot of people are holding, okay, Ledger, then are you really self-custodying? That's the question you would have to ask yourself. Let's move on to Bitcoin. We're continuing to see this consolidation pattern between around the 26,500 area to 27,500. Now, the more that we continue to consolidate in this area, the bigger the move will actually be. Now, based off of the information that we've given on this, we saw the 2-day strategy that we've been discussing here come down to the 55-day moving average, which triggers that particular trade when we touch the 55-day moving average, followed by with low volatility. That triggers a move to the upside. Hopefully, as long as we don't drop below, again, 26,500, then that spells very bad overall in this consolidation phase. Now, what I'm particularly seeing is that if this move were to play out, your stop loss would most likely be set around the 24,200 area. So that's where I would put my stop loss at a 9% loss. Now, that's playing with small amount of capital with low leverage. 2x leverage is more than enough for us to make some good profits, even if you're starting off with $200, $300, $400. Remember that if you are trading does take time to actually build your capital. The most important thing is that you focus on your craft, you build that risk management. You need to understand you can't risk everything on one move. You need to have a stop loss. You need to have a plan when you go into these trades. And without a plan, you basically plan this to fail. That's what it is. Now, based off of what we've been discussing here, is that you're giving 9% for 50% here, upside move. Now, if we were to drop, that would spell coming down to these areas over time. What we were going to see is that our reward factor in regards to this, based off of the data that we looked in the previous, I don't want to go too much into it because it'll become too redundant. But based off of this, we're looking at around a 49% move, okay, in Bitcoin, which brings us around the $38,000, $39,000 area, which has a lot of confluence of resistance right here. So very heavy resistance around this area, and which is going to play a key role overall on the big macro picture. I'm not saying that this is going to happen all in one shot, and this is what happens when you consolidate in a particular area. You're bound to have these big moves overall. Now, we are saying on the daily, and we're putting in higher low on the oscillator, while you are putting lower low on the price action. So as you can see, lower low while you're putting higher high on the oscillator. So this spells very well that if we were to come back to this oscillator right here, bounce off of it, and then hopefully go up from there. That's why we set our stop loss to 2400, because look, if the oscillator wanted to come down, which it looks like it wants to come down, maybe our saving grace would be around that area. Most of the liquidity that will come in will be to, most people will set their stop losses there. But that's what we're seeing, just like boring consolidation phase overall in the next few days. However, I do see a resolution coming into play for this overall pattern in the next few days to a week, guys. I'll leave you off with that. I hope you enjoyed this video. Until next time, bros, as always, stay profitable.